Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome to the Deep Dive. Today we're really getting into the weeds of global private markets.
That's right. Our guide for this is McKinsey and Company's Global Private Markets Report for 2025. And, hats off to McKinsey for such a thorough piece of work.
Absolutely. It gives us a fantastic base. So 2024, it was a complex year, wasn't it? Lots of uncertainty swirling around.
Definitely complex. But what really stands out from the report, I think, is the resilience. You see a lot of adaptation happening across the board.
Okay. Resilience and adaptation.
Yeah.
So our goal here today is to unpack those findings, cut through some of the noise, and figure out what's really important. What does it mean for you listening if you're an investor, a manager, or just trying to understand this huge part of the economy?
Exactly. We'll look at those, sometimes contradictory signals, see how different asset classes performed, and try to connect the dots on where things might be heading.
All right, let's start with that big picture McKinsey painted. You mentioned mixed conditions for 2024. Deal-making was, slow.
Yeah, tepid is the word they used. And traditional fundraising, the classic closed-end funds, hit its lowest point since 2016 across all asset classes.
Okay, lowest since 2016.
Yeah.
That definitely sounds like a challenging environment.
It does on the surface. But here's the twist, and this speaks to that resilience point. Capital deployment actually increased by double digits.
Increased. So even though raising new money was harder.
Exactly. Managers were still putting capital to work, either finding good deals or, supporting the assets they already had. The money available was being deployed.
That's a really critical point. And it wasn't just deployment showing strength. What about investor sentiment? LPs.
That was another positive signal. McKinsey surveyed over 300 leading LPs back in January 25, and they found investors actually plan to allocate more capital to private markets in the coming year.
Wow. So despite the recent bumps, that long-term belief in private markets is still there.
It seems so. The conviction holds. But of course, the report doesn't ignore the challenges. Big ones were flagged: geopolitical instability, shifts in trade policy.
And AI, right. Generative AI is everywhere.
Yes, the rapid advance of Gen AI was right up there as a major factor everyone's grappling with.
So faced with all that tough fundraising, global uncertainty, tech disruption, how did people adapt? The report talks about resilience across the board.
They really had to. Fundraisers, for instance, they started looking beyond just the traditional funds, exploring things like evergreen funds more seriously, different structures to bring in capital.
Makes sense. Trying different doors when the main one is harder to open. What about on the deal side? The operators.
A really significant shift there. Less focus on, let's say, financial engineering, just using leverage.
Which was the playbook for years with low rates.
Right. Now it's much more about sustained operational transformation, actually improving the underlying business. That's where the value creation focus is shifting, especially when debt isn't cheap anymore.
That feels like a fundamental change. You have to be a better business builder, not just a financial architect. And the LPs, the investors.
They're evolving, too. The report shows them moving from being, somewhat passive allocators to more active players, getting involved directly with GPs through secondaries or buying stakes in the management companies themselves.
More sophisticated engagement then. Okay, so adaptation everywhere. Let's dig into the specific asset classes now, based on the report. Where should we start?
Let's kick off with private equity. McKinsey calls it emerging from the fog.
Emerging from the fog. I like that. Because the headlines felt pretty foggy, right? Fundraising down 24% year over year for traditional funds. Returns maybe not sparkling compared to public markets recently.
That was the immediate view, sure. And fundraising was down for the third year straight. But emerging captures something else starting to happen beneath the surface.
Okay, so what positive signs were breaking through?
The big one, and this is crucial for LPs distributions, finally ticked up. Money going back to investors. Based on the first half of 2024 data, distributions actually exceeded capital calls for the first time since 2015.
That is big news. LPs have been waiting for that liquidity. And didn't the report say LPs care much more about that now, DPI?
Exactly. Distributions to paid-in capital. The survey found DPI is way, way more critical for LPs now than just a few years ago. Like 2.5 times as many LPs rank it top priority. So that uptick in distributions, it directly answers a major LP concern.
Got it. So money flowing back out is a key positive. What about money flowing in for deals? Was deal-making still stuck?
No, actually, that started to pick up too after a couple of years of decline. The report highlights an increase in both the value and, significantly, the number of large PE deals, think over $500 million enterprise value.
Okay, bigger deals getting done. And exits.
Exit activity also started to whir back to life a bit, especially sponsor-to-sponsor deals, one PE firm selling to another.
And the financing backdrop improved somewhat. That was a huge hurdle.
It did. The cost of buyout financing came down from its peak, though, importantly, still higher than the long-term average. But new loan issuance for PE-backed companies nearly doubled in 2024.
So more available credit, even if it wasn't super cheap again.
Right. And that improved financing, maybe some optimism about future rate cuts, even helped push entry multiples up again after they dipped in 2023. Sponsors felt a bit more confident paying up.
It just highlights how much those huge rate hikes in 22 and 23 really shook things up for an industry used to cheap money.
Oh, absolutely. A massive adjustment. But, despite all that, PE's appeal seems durable. The report notes 30% of LPs still plan to increase their PE allocations.
And the long-term numbers still look good compared to public markets.
Yeah, since 2000, PE has outperformed the S&P 500 according to the report's data. So that long-term story remains attractive.
Okay, so LPs still believe long-term.
Mm-hmm.
We talked about the shift to operations. How else are GPs adapting? You mentioned new deal structures like take-privates. European P2P up 65% in 2024. That's a specific jump.
Yes, and they're innovating heavily on fundraising, too. That traditional closed-end fund AUM actually dipped slightly in the first half of 24, but that's not the whole story.
Right, because they're using other ways to manage money.
Exactly. Separately managed accounts, co-investments, various partnerships. These are adding trillions in capital outside the traditional fund structure, and they're reaching new types of investors.
High net worth individuals.
Correct. Working through aggregators and wealth platforms to tap into that significant pool of capital, often using different fund structures like open-end or semi-liquid funds that offer more flexibility than the old lockup model.
Diversifying their funding.
Right.
And things like continuation vehicles also help with liquidity for existing LPs, right?
Precisely. It's all about providing solutions in a tougher environment. Now, an interesting point the report makes is about scale. You see the big players consolidating, the top 100 GPs buying up competitors.
It seems like an advantage.
It can be. But the report is careful to note that the link between just being bigger and having better performance or easier fundraising isn't necessarily clear-cut.
Oh.
And here's a fascinating specific finding for 2024. The report states that smaller mid-market funds were actually easier to raise than the largest mega funds.
Really? Easier to raise for the mid-market. What does that suggest?
Well, it could be a few things. Maybe LPs seeking diversification away from the giants. Or perhaps, tying back to that operational focus, the value creation story feels more manageable or less dependent on huge leverage multiples in that mid-market space right now.
Interesting. So the biggest aren't always winning the fundraising race, especially in current conditions.
It highlights that the mid-market remains a very active and apparently somewhat more accessible part of the fundraising landscape last year.
Good insight. So despite PE emerging from the fog, where are the lingering clouds?
Venture capital definitely stands out. It saw sharper declines in deal activity and less value growth than buyout or growth equity.
Okay, VC still struggling more.
And geographically, Asia lagged behind other regions in fundraising, performance, and deals, largely reflecting the complexities in China.
Right. What other big challenges remain for PE overall?
The elephant in the room is the exit backlog. It's huge. McKinsey says it's larger now in value, number of companies, and as a percentage of portfolios than at any point in the last 2 decades.
Wow. That's a massive overhang. Selling those assets is tough.
Incredibly tough, especially anything bought at peak 2021 or 2022 prices. And refinancing portfolio company debt in this higher rate, more cautious lender market is still a major headache for many GPs.
Plus those external pressures, geopolitics, trade, and integrating AI effectively.
Absolutely. Building data science teams, rolling out AI initiatives in portfolio companies, these aren't optional anymore. They're becoming core to the value creation strategy.
Okay, complex but adapting picture in PE. Let's switch to real estate. The report calls it reaching for daylight.
Yeah, it implies things were pretty dark and maybe some light is appearing. Deal value did grow globally by 11% in 2024, hitting $707 billion. First growth in 3 years.
What drove that?
Partly expectations of rate cuts, maybe stabilizing things, some cap rate compression, meaning yields relative to value stopped rising as fast, and also tight supply in favored sectors like multifamily and industrial.
So deals were happening, but fundraising, not so much.
Oof, no. Fundraising really struggled. Global closed-end fundraising dropped 28% to just $104 billion. That's the lowest since 2012. Real estate debt fundraising also fell off a cliff, down 44%.
A really tough year to raise a real estate fund, then. And performance.
Still generally negative at the fund level. Closed-end funds had negative IRRs, negative 1.1% through Q3 24, and open-end funds were also negative 1.6% for the year. Second straight year of negative returns for open-end, which hasn't happened since the GFC.
So where's the daylight coming from? Any bright spots?
Well, property-level returns, looking at the actual assets, were positive according to the NCREF index, thanks to income and some appreciation. And certain niche or alternative sectors did well.
Like what?
Manufactured housing showed strong returns, 11.7%. Senior housing, too, 5.6%. And again, data centers were a standout, 11.2%.
Data centers keep popping up.
They do. And it links to another point. GPs with real operational expertise, especially in specialized sectors like data centers, managing power, tenants, zoning, they're gaining market share. Operational capability is now behind 37% of real estate AUM, up significantly over the last decade.
So same theme as PE operations matter more and more. Okay, let's look at private debt, described as steady in the crosswinds.
Steady feels right. Despite the headwinds, private lenders kept financing LBOs. New issue volume actually increased in the U.S. and Europe in 24, supporting that pickup in PE buyouts.
How did private debt fundraising hold up compared to others?
It was down 22% to $166 billion, but that decline was less severe than PE or real estate saw. It seemed to weather the storm a bit better, maybe because debt feels safer in uncertain times. A lot of the drop was specifically in mezzanine funds.
Interesting. How's the competition shaping up? Banks were retreating, but are they back?
That's a key evolution noted in the report. In 2024, banks and the syndicated loan market actually became more competitive again, taking back some market share and showing more willingness to lend.
So direct lenders faced more competition.
Yes, which led to spreads compressing. The premium direct lenders earn over syndicated loans tightened by about 120 basis points. Direct lending still dominates LBOs by value and count, but its share slipped a bit.
So why does investor interest stay strong if competition is up?
It really comes down to that position in the capital stack. Being debt, it's seen as safer than equity. That appeals to institutions, insurance companies, even retail investors now. The ecosystem keeps growing as more financing moves away from just traditional banks.
And there's a big opportunity coming up.
A potential huge one. The maturity wall. There's over $620 billion in high-yield bonds and leveraged loans coming due in 2026 and 2027.
That's a lot of debt needing refinancing.
Exactly. It's expected to create significant demand for private credit solutions. A big opportunity, but managers will need to be disciplined in underwriting.
Definitely something to watch. Okay, last asset class, infrastructure. Poised for clearer conditions.
Yeah, although again, the fundraising number might make you pause. It was down 15% in 2024, a 10-year low, and tougher for new managers to break in.
So why poised for clearer conditions if fundraising was down?
It's about deployment and, crucially, LP sentiment. Capital deployment in infrastructure really accelerated. Deal value shot up 18%, the second highest year ever, and deal count rose 7%. Dry powder actually decreased because money was being put to work faster.
Okay, so deals were getting done with existing capital,
Yeah.
and LPs are keen.
Extremely keen. This was the asset class with the strongest LP conviction in the McKinsey survey. 46% of LPs said they plan to increase their infrastructure allocations over the next year. That's the highest across all private markets.
46%. Why such strong conviction there?
Several massive long-term tailwinds. Growing global trade needs ports, rail, logistics. The energy transition is maybe the biggest driver. Trillions needed annually for clean energy and the grid to support it.
Electrification needs infrastructure.
Massively. Plus, demographic shifts driving demand for essential services. And yes, AI again.
How does AI feed into infrastructure demand?
Power. Huge power needs for data centers driven by AI and the cloud. The report points out U.S. electricity demand jumped 2% in 2024 after 15 flat years, largely because of data centers. That needs generation, transmission, the whole supporting infrastructure.
A really tangible impact. How are infra managers responding?
They're investing where these themes overlap, like energy and digital infrastructure for those data centers. And, mirroring the other classes, active ownership and underwriting specific value creation plans, not just buying and holding, are becoming critical differentiators.
So, let's try and pull this all together. The McKinsey report shows private markets really grappling with, but also adapting to this environment of higher rates and more uncertainty.
That's the core message, I think.
Yeah.
Adaptation and resilience. Yes, fundraising was tough, especially for traditional funds. But deployment picked up, showing capital found a home. And LP belief in the long-term value is still strong, particularly for infra and PE.
And a huge theme is GP innovation. New structures, new capital sources, but maybe most importantly, that fundamental shift towards needing real operational chops to create value.
Absolutely. Relying on cheap leverage or just market timing isn't the winning strategy anymore. It's about improving the assets. But the challenges are still very real.
Right. Let's not forget those. That massive PE exit backlog is a big one. Refinancing risks persist. And the whole question of how to effectively harness AI.
Those are the key hurdles the industry needs to navigate in the coming years. It's definitely a market in transition.
It really is. Resilient, adapting, but facing significant structural shifts.
Couldn't have said it better.
Okay, so here's a final thought for you, our listener, to chew on based on this deep dive into the McKinsey report. We heard about the enormous exit backlog in private equity, and we heard repeatedly how crucial operational value creation has become, perhaps more than ever before. So does the path to actually achieving successful exits now depend less on trying to perfectly time the market and much more on a manager's ability to demonstrably build, improve, and prove sustainable value within their portfolio companies, almost regardless of the broader economic winds? Something to think about.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.